Welcome back, guys and girls. Greg Silverman here, Chief Investment Officer. This is another session of Come Learn With Me, where we go through some of the articles which were ranked highly for the last week that we curated on our social media. So let's check out this one. This one has to do with the ongoing bond route, shall we say. And then if you stick with me to the end, I'll tell you a little bit more about some of our programs, our investment programs that you can tag along with. Global corporate bonds lost 1 trillion and risks are rising. And this is March 30th, so it's about 20 days old, 24 days. Investors in corporate bonds are bracing for more trouble after getting hammered by rampant inflation and rising yields in the first quarter. And this has continued to occur since the article was published. The worldwide pool of the safest corporate debt has shrunk by 805 billion this year, while the global junk market lost 236 billion, according to data compiled by Bloomberg. It's the biggest dollar decline since records began over 20 years ago, following a borrowing binge propelled by record low funding costs. Investment grade index lost about $1 trillion in market value. Wow. Yes. Which is quite rare if you look at that chart. Most years are positives. Those are quarters, right? Slump marked the biggest total return loss for high-grade bonds since Lehman Brothers collapse, and the worst junk performance since the start of the pandemic. The U.S. investment-grade market alone saw about $440 billion in market value raised and is on track for the biggest 3-month slump since 1980. Credit remains under pressure from inflation, which is pushing central banks to boost rates, in turn risking an economic slowdown that's causing plenty of angst for investors. We are far enough from inflation picture being clear that you can't help but think volatility will persist, said Brad Rogoff, head of global FICC research at Barclays PLC. Meanwhile, Russia's invasion of Ukraine has increased concern about Europe's ability to fulfill its energy needs and is further disrupting already struggling supply chains around the world. We've really got a lot of things we have to contend with, said April LaRousse, head of investment specialists at Insight Investments, which oversees £867 billion. Given that there can be endless talk and quite little progress between Russian and Ukrainian negotiators, it's probably unwise to put a large directional bet. As losses racked up, retail investors yanked cash from bond funds. Outflows are likely to intensify as they tend to lag returns by about a month. Bank of America corporate strategist wrote in a note Tuesday. A recent BOA survey found that inflation is the #1 concern among credit investors right now, followed by geopolitical risk. Investors remain bearish. Bank of America analyst, credit strategist Yuri Seliger wrote. Ukraine outlook. Skeptical NATO allies are evaluating whether Russia promised to scale back military operations in Ukraine marks a turning point in the conflict or simply a tactical shift. Hopes for progress in negotiations help bring spreads in global credit, global high-grade debt below levels last seen before Russia's invasion of Ukraine on February 24th. Morgan Stanley's US and European credit strategy chief warned this could prove a blip as focus shifts to central bank hawkishness. Losses have been coming from all sides, especially in the high-grade market, which is more exposed to the global rise in government bond yields as central banks tighten policy. This is due to higher duration bond parlance for price sensitivity to changes in interest rates. Yields on 10-year US Treasury and government bonds have surged to their highest level since 2019 and 2018, respectively. US 2-year yields briefly exceeded the 10-year level on Tuesday for the first time since 2019, signaling that rate increases by the Federal Reserve could trigger a recession. Meanwhile, corporate bond risk premiums above supposedly safe debt has also jumped this year. While spreads reverse some of their widening in recent weeks, analysts expect pressure to resume. In Europe, bonds indicated at a discount to face value now account for 2/3 of the euro high-grade market from about a quarter at the end of 2021. Persisting risk. Still, what looks cheap now can get even cheaper later, especially as the risks that have driven first quarter losses look set to persist. 12-month forward excess return expectations from current levels are historically good, said Greg Venizelos, a credit strategist at Axis Investment Managers, which oversees 887 billion euros. This doesn't mean there's no further downside. It's a good entry point, but could get even better in the weeks ahead. It's prudent to stay a bit cautious. Well, we have had a 20-year bull market in interest rates, so I would Yeah. To be sure, sharp price drops have allowed some investors to scoop up what they regard as bargains at spread levels not seen since the start of the coronavirus pandemic. We view investment grade in dollars as a strong buying opportunity, probably the best opportunity in the current environment if we think in terms of risk-adjusted expected returns, said Eric Van Ras, a portfolio manager at Eric Sturza Investments, which oversees $1.7 billion. The widening of spreads has been amplified by poor liquidity, Van Ras said. It will improve when people like us seize the opportunity and become buyers of the asset class. Elsewhere in credit markets, Americas, 4 issuers are now selling new US high-grade bonds, including Workday Inc. and DT Midstream Inc. Churchill Downs Inc., own and operate the racetrack that hosts the annual Kentucky Derby, is tapping the US high-yield market for $900 million to help finance its asset purchase of Hard Rock Sioux City owner Peninsula Pacific Entertainment LLC. Russian default fears ebbed further as the government's latest interest payment started to show up in some bond investors' accounts. For deal updates, click. Okay. All right. EMEA talks about the deals going on there. Payment related to Swiss franc bond by Russian Railways has not gone through for compliance reasons. All right. Well, there you have it, folks. This is I call it the big unwind in interest rates, right? It started and it seems to be gathering steam. So interesting times, interesting thoughts about investing. If you want to know more about our investment themes, take a look at some of the links below and hit me up. Let me know what you're thinking and where you're putting money in the market. Greg Silverman out for now.